Thank you so much for coming, Mr. Brown.
My pleasure.
It's the first time that you are with Bloomberg HT, the Turkish Bloomberg TV. It's a pleasure to have you here, and also it's a day full of surprises in the equity markets. Shall we start with the payrolls? Payrolls in U.S. rise more than forecast. Is this a surprise to you?
It is a surprise, 146,000. Most people were looking for, say, around 85,000.
That's right. Bloomberg's survey said 85. Some people said 58. What did you think?
I thought it would be a confusing number. So we had Hurricane Sandy,
yes,
and that was going to disrupt things. So I think while it's a positive surprise, we have to take it with a little bit of a grain of salt because the expectations have been brought down because of Sandy.
But the market is reacting to it positively.
Oh, then I'm all for that.
Is it realistic?
We are net long, and so we want to see the market go up in the short run. So I'm encouraged.
Is it because of all the talks, all the problems going back and forth with the fiscal cliff? Do you think the market is waiting for some kind of an excuse? Or do you think the market sees there's a light at the end of the tunnel after the talks with the Republicans yesterday?
I really do think, as we talk about it every day, it is so much of the news, I do think the generally investors expect a deal. Whether the deal happens before December 31st or in the first week of January, there is optimism that a deal will be struck. And that could be a concern because it could be that no deal is struck by December 31st and then people get even more concerned that one will be struck in the first part of the next year.
And with the worst case scenario, what would happen?
I am not that concerned about going over the cliff. So we have a short-term problem and we have a long-term problem. The long-term problem, of course, is our debt and deficits. If we go over the cliff, it creates a short-term problem because you have this huge negative impact on the economy in the first part of 2013. But longer term, it cuts the deficit in half. So we help our long-term problem, but we create a short-term problem.
And do you think within this limited time period, yes, Obama said this has to be solved before Christmas, but is it like a Band-Aid? Is it going to be really helpful? Because all these problems cannot be solved overnight or in a week.
Yeah, it's so true. Now, every solution that we've heard, all the proposals, are just different versions of a Band-Aid. So the market will have some sort of relief if an agreement is reached, but we haven't done anything at all to solve our long-term problems.
What would be the best solution, in your opinion?
Well, my opinion is we don't have a revenue problem in the United States. We're going to take in $2.8 trillion this year. What we have is a spending problem. So we have increased spending over $1 trillion since the president came into office. Revenues are flat. Our deficit is $1 trillion. I suggest we cut spending.
I totally hear you. You are the CEO of Second Curve Capital. You're a buy-side firm. Can you tell us a little bit, because I like to know how you were impacted from what we are talking about, the fiscal cliff and also the so-called slowdown and the global slowdown.
So we just invest in financial services companies. Right now we're only invested in U.S. financial services companies. We have a disproportionate number of banks that we own, from Bank of America down to a $1 billion bank in Michigan. So we own banks of all sizes. In general, what they're recovering from the credit problems that they had in the sort of the 08, 09, 2010 time period.
How is the business I mean, are you satisfied with 2012? Did it affect you? I mean, are you overweight more in banking?
It affected us a lot. So our funds are up anywhere from 75% to 100% this year. So it's really been a great year. And we'd like to end the year right now if we could.
And what are your projections going forward for 2012? Because you know, some strategists, some analysts, they are reducing their S&P 500 estimates to about by 1.8%, 2% Wells Fargo. Others, they increase it, and they say 2013 will be even a better year. What is your opinion about
I don't think it's going to be a great year, and I don't think it's going to be a terrible year, because I think the economy is only going to grow at 2 to 3%. So until we solve some of these longer-term problems, or give investors confidence that we're going to solve these problems, we're on the road to do that, then I think the economy stays in a sluggish sort of growth, positive growth, but nothing to dramatically increase employment or to dramatically raise the equity market.
And you mentioned that you cover the banks. And there's a report, there's an article about Bank of America. Bank of America needs some city-like cuts, analyst says in this article. TheStreet.com published it, and they quoted you. And you said traders want to own the beta names. And you also mentioned before the show today that you met with the CFO of Bank of America. What did he say, and do you expect Citigroup-like cuts, and if so, how many?
Well, Bank of America was a little surprised that Citi got such a reaction to their $1 billion of cuts, because Bank of America has two different cost reduction programs. One of them is to take $8 billion out of their normal banking business, $8 billion. And the other one is to, as their residential mortgage loan problems decline, that the expenses related to those are going to go from $12 billion to $2 billion. So that's another $10 billion. So at Bank of America, they have programs in place to save $18 billion, and Citi saw their stock rise 6%
just only by
saving $1 billion.
Why so?
Well, I think in Citi's case, and I agree with this, it's a signal that there's more cuts down the road. So Bank of America has two huge programs that have already been announced and are in the process of being executed. Citi just announced one, but I think you can expect in
more
2013 and 14, yes, more to come.
There was speculation that they were saying this is just the start of the earthquake series. So do you agree? How much should we expect more from Citigroup?
I think you should expect another $5 to $10 billion of expense cuts.
And what would the effect would be on the markets of this kind of a transformation?
Well, these two companies, Citi and Bank of America, are both trading below their tangible book value because their profitability has been so low. So now these expense reduction programs will raise the profitability, and I think you will see both stocks go back to trading above their tangible book value.
Interesting. Well, we have very a little left. I would love to talk to you more, but I know you said you're invested in totally U.S. But if you look at out of the U.S., where would you invest your money in?
European bank stocks. So
why European bank stocks?
Yes, because I think the problems that we saw in the U.S. and were dealt with, and we're seeing the same sort of things in Europe. And while they have had nice moves off of their lows, I think there's more to come.
So it's more devaluation.
Yes.
You find them to be. I think Mark Weber said the same thing, didn't he? So you agree. How about Turkey?
I don't know the Turkish banks.
But soon to know. Thank you so much for coming and sharing your valuable comments and all these information with us. Thank you, Mr. Brown.